Hello and welcome back to another episode of the Mark Moss Show, where we talk about the decentralized revolution that is happening across the world. Of course, we're talking about Bitcoin, talking about cryptocurrencies, and the way the world is changing, looking at the intersection of politics, finance, and technology. Now, I try to bring to you some education so you can understand what's really going on, cut through the nonsense, through the noise, and see the signal, see the real data, the latest breaking news. And I try to bring some new interesting guests so you don't have to hear me talk all the time. And today I am joined in the studio by TXMC. You can find them on Twitter at TXMC Trades. And we've done a couple Twitter spaces and stuff like that together. And man, I really enjoy your insights. So thanks so much for joining me today.
Thanks for having me on, Mark. Been looking forward to talking to you, buddy.
Yeah, we've gotten into some good conversations on the Twitter Spaces, but, with so many people on there, it's hard to, really dig in. But, I do enjoy the analysis that you've been putting out there. Kind of a lot of the same stuff that I look at, obviously Bitcoin, but also greater, the why, as I like to call it. So the catalyst for it, the macro picture, if you will. So we'll talk about all those things. Starting off, I saw you tweeted out earlier today that everything on your chart was green. Bitcoin is green, the Dixie is green, gold is green, oil is green, the bond yields are green. What do you make of that?
I've been thinking about that today. Went out to lunch with my family and trying to think about what I think is going on in the market. And I don't have, great answers for all of it, but I think that we're kind of at an intersection here where the market is trying to figure out how seriously it takes the Fed at trying to basically engineer a recession. And, there's a lot of leading economic indicators that are suggesting we're heading into one or that we're currently in one. But at the same time, people see commodities coming down. They suspect that inflation has peaked, and they are hoping that means that some of the worst may be behind us. And I think that some of that push and pull is why on a day like today, the many things are up when you would expect, if the dollar is really strong and oil is really strong, maybe we wouldn't see so much strength in tech stocks and elsewhere, but everything across the board is green. So I think there's a lot of uncertainty in the market. That's how I take it.
Yeah, well, there's no doubt there's a lot of uncertainty in the market. I don't think I've ever felt more uncertain about the markets at any point in my career, and I've been through a couple of these bear markets. One thing, when you look at the blow-off top, so if you look at, market cycles, if you pick any one, go back to the dot-com boom or 2017 Bitcoin boom, you see that you go into these parabolic runs, and it starts sucking more and more buyers and goes into this parabolic advance, and then it gets very volatile at the top, and then it blows off. But it doesn't always just blow off in a straight line. Then it has the bounces and it gets super volatile. And maybe that's just kind of where we're at. I was talking with Macro Alf Macro yesterday.
Love that guy.
And he really focuses a lot on the bond side of things. And he was just saying kind of the same thing that you're saying, which is the bond markets are saying they don't believe the Fed. They don't believe the central banks are going to go through with this. That's what the bonds are pricing in. And so it kind of goes along with what you're saying. But it is interesting to see the dollar index, as you have on your chart here, the DXY, which is the dollar compared to a basket of currencies, really just kind of the euro mostly. How the dollar's been getting so strong lately. And it looks like, I was looking at some charts yesterday, it was almost like a direct correlation, an inverse correlation with the strength of the dollar and commodities taking a dip at the same time. Which is interesting. So I started trying to look at the commodities priced in other currencies to see, is it really just the dollar getting stronger or the commodities getting weaker? But then in this chart that you posted today, we see the Dixie is strong and we see the commodities and other assets being strong at the same time. So I thought that was pretty interesting.
Yeah, I think part of what's happening with the Dixie is the weakening of the euro and the yen, which is kind of what you were describing with it mostly being the euro. And so I think that, and I'm certainly not an FX expert. I'm still very much trying to learn and get an idea for intuitively interpreting these markets. But the basket, the makeup of the DXY is important to which direction it's going in. And it's not always necessarily dollar strength that's leading, but perhaps weakness in the other members. And I think that's part of what it is here, and commodities, they've been coming down. They've bounced a little today, but I think there's very real concerns about a recession, even more so in Europe than here in the US. And I think that's playing a role in the Dixie's strength.
Yeah, for sure. Well, and we have a situation where, in the United States, we've been raising rates, talking about tightening, not really tightening yet, but talking about tightening, when the rest of the world and back to Europe, they've been in the situation where they've been trying to ease. Then they said, okay, well, we'll try to tighten. But as soon as they try to tighten, things have just gone off the rails, and they're quickly, frantically going backwards on that. Christine Lagarde talked about something called fragmentation, which is basically just a fancy word of saying more redistribution, right? Well, let's just take it from the good countries and we'll give it to the bad countries, and doesn't sound like a good plan. Have you looked into that?
I've been trying to read a little about it. I'm not satisfied with my opinion on it right now, but they've got a big mess on their hands.
Yeah, they got a big mess, and it doesn't look like it's going to make it. That doesn't seem like they're going to have a good way of getting out of this. Now, I want to talk about, we'll talk about this bigger macro picture, which I think is important to understand, because it's, the big catalyst. It's the fundamental drivers of most assets, all assets pretty much today. And then we'll bring it back into Bitcoin, and we'll talk about that specifically. But if we just kind of stick on this macro trend, one of the big fears I think that the Fed has too, and we're starting to see it, is in the credit markets. And so I think what the Fed wants to do, the central banks want to do, is make sure there's enough liquidity to keep the system going. And I know you had posted a chart also on the corporate credit spreads. Mm-hmm. So you want to look at the bond market. The bond market typically kind of tells you where the equity markets, the debt markets tell you where the stock markets are going to go. And we're starting to see these corporate credit spreads really starting to get wide, and it looks like the credit markets are getting pretty dangerous. What's your take on that?
Yeah, I've been meaning to dig in and look at the different layers inside of the credit spread, because I posted an index that puts a bunch of them together, and it's they've been going down for a while. And if you look at emerging markets ETF, or you look at HYG or JNK or any of those, it's been down only, and I think that's a really risky place. That was in part what blew out in 2018 and kind of forced the Powell pivot. But also, there's so many companies we've got that have propped up on debt over the last couple of years, so many zombified companies. And, with the seeming lack of demand for corporate debt, you greatly accelerate the likelihood of defaults in that market, as buyers are leaving, and with rates rising where they are, some of these people are going to get downgraded. It's going to be harder for them to get financing. I think that market is ripe for some serious deterioration, and we're getting close. Like you said, that chart I posted this morning, we're past the level we were at in 2018 that caused Powell to pivot at that point in time, but it's unclear if that is going to be enough this time around. It seems like their focus is elsewhere, probably mostly because of inflation.
Yeah, and I think that you just nailed it with that point. They've come out and said as much, right? So in the last meeting they had, Powell said, we are committed to getting back to 2% inflation. And so, they vowed, they promised, they're committed, all these big fancy words. But I think they're pretty much focused on that number. So in the past, you kind of point back to 2018, we're getting back to the levels where they had to come off of that. So for the listeners, Jay Powell came in, took over the Fed, and was fired up to change the system. And he wanted to get back to normal, and he wanted to raise rates back up again and all these things. He wanted to decrease the balance sheet, all these things. He wanted to fix the system. And very quickly, the markets didn't like that, and they started rolling over very fast. And to the point TXMC is making, they were forced to pivot off of that because the markets were breaking apart. But today, the markets are breaking apart worse than we saw at that dip. But at the same time, they're not ready to pivot. And I think it's because they're focused on a completely different metric, which I want to dig into with you even more. You're listening to the Mark Moss Show. We're talking about the decentralized revolution, talking about Bitcoin, cryptocurrencies. We're talking about the markets, the reason why we need Bitcoin and what drives that. I'm in the studio with TXMC. You can find them on Twitter at TXMC Trades. We're going to be talking about that. I want to talk about, again, like I said, the markets. I want to dig into some unemployment, some other metrics, look at what the Fed's focusing on. We're going to bring it back to Bitcoin and what we think is going to happen with Bitcoin in the near future. The Fed pivot in 2018 and how they're looking at different data. So last time they moved on the markets, and a lot of people this time were thinking that, maybe they'll let the markets drop 20% before they pivot. And now here we are much further, 25, 30%, depending on which index you're looking at. And yet they don't seem to be ready to pivot. And in my opinion, I basically have listened to what they said, and they said they're focused on getting inflation back under control. I spoke at a conference 2 weeks ago, about a week and a half ago, and Joseph Wang was there. He's a former Fed insider and a Fed bond trader, and he said the same thing. He said they're 100% committed to that. He said they need to see meaningful movement off of that. So we're at 8.6. They need to see a 7.6 and a 5.6 before they'll do anything. But a lot of people also think they'll wait until something breaks. What do you think about that?
Right. That's the $1 million question.
That's the $1 million question.
Yeah. What's the thing that's going to break? And I think there's a lot of different forces that are working here, right? You named inflation. That's their clear stated number one priority. It's the number one priority of voters in a midterm election year, angry voters. And inflation affects everyone. It affects more people than falling asset prices do, right? Like the stock market affects a certain percentage of Americans who have a lot of their wealth there, but there's half of America or more that don't have any stock exposure to speak of or anything meaningful. And so they don't really care so much about what the S&P is doing. They care about the prices of gas, the price of shelter, right, the price of meat and eggs. Right. I think what we're likely headed for, it's hard to know what the thing is that will break. Maybe it's the credit markets like you and I were just talking about. We thought it was going to be the bond market, but it seems like they've done most of their sell-off, at least to this point, and maybe they're waiting for some new narrative that drives yields higher. I couldn't fathom yields breaking out of a 40-year trend with record debt, but regardless, it seems bonds have cooled off a little bit. So with all of this talk about unemployment being low, the labor market is strong, that's what they keep saying, I really feel that they're just going to continue tightening until we have some kind of a blowout in the labor markets. And then they're forced to seriously consider helping people through stimulus or reinvigorating the economy, even though inflation is really high. And I think this controlled demolition, which is a term I've heard a lot of people use. Danielle DiMartino Booth has talked about this a lot. I feel like over the last few months, we haven't seen that sharp, volatile fall from a bubble pop like you were describing. And it's been more of like this controlled demolition. Like you said, the Fed hasn't tightened that much. They've talked a lot about tightening. And the market has done 90% of the work for them. And the bond market even got out ahead of the Fed a bit, which is why I think partially it's coming back some. I really believe they're going to continue to tighten. And because of some demographic issues, there's only, I think, so much labor that can really come back. And so they're hoping to see job openings fall, or at least that disparity between the people who want to work and the amount of available work close down, because that's what they're calling demand. And I really think that as long as inflation remains elevated and it continues encouraging them to stay on this path, that they're just going to push until something like that breaks. And if we're about to have a Q2 earnings season, it's anyone's guess how good or bad it is. And if we see some surprises to the downside, if there's serious pain inflicted on consumer spending on the nominal level, because I think most people are looking at nominal numbers going up because prices are going up and they're ignoring the weakness in real numbers. But if we see actual falls in consumer spending, that might start to wake up the Fed, because the economy is powered by the consumer. It's powered by their spending, and that is what powers tax receipts, which currently are not enough to pay the government's obligations. They have to get money from somewhere. So there's a certain point where falling GDP is antithetical to the Fed maintaining good standing on the debt.
Yeah. Yeah, I mean, there's so many levers. It's such an intricate web to sit there to try to unweave, if you would, and it's like the one thing we can see is that if they're committed to bringing inflation down, and they're talking about price inflation, so the price of consumer goods. And so when you talk about gas prices are a big thing. We see the president tweeting about that all the time. He doesn't know what he's talking about,
right?
But he's still tweeting about it. We know it's a hot point, right? So gas prices, food prices. I commented on a tweet from Lynn Alden earlier today talking about how food prices have gone up by 12% in the same time that, what is it here? She said, price of food used at home rose 12% last year, while average wages rose 6%. And so like that's a big problem for people to have. And I had said basically humans can take a lot of pain and struggle brought on by central planners as we approach peak centralization. But the catalyst that always swings the pendulum back is always food. Because if you can't eat or feed your family, it's time for change. And so we have food and energy, right? Those are kind of the two main things that you need to live. And so people are screaming about that. And so the Fed can't print more food or energy, right? They can't do that. Right. And there was a testimony I talked about, I think a week or two ago, and it was Senator John Kennedy, and he was questioning Jay Powell. And he said, so, there's two levers, right? Supply and demand, and the Fed can't increase supply, so you're focused on destroying demand. Is that right? And Jay Powell was like, yeah, right. We're focused on destroying demand. They talked about we need to bring stocks down to lower demand, so the wealth effect, right? So if they make people feel poor, their retirements come down, their house come down, et cetera, they just spend less. And so I think the point that you're making, or at least I think, is, and I'm agreeing with, is that looking at the consumer spending is probably a better indicator than the CPI, because the CPI is more of like a lagging indicator. And if they're starting to spend less, then we know the prices might be coming down. Is that kind of what you're seeing?
It is. Their spending and their wages are the things that I watch a lot. And, real wages are quite negative. And real consumer spending is not strong, despite nominal values being elevated because prices have gone up. There's certain things people just have to buy. It doesn't really matter how expensive it is. They can only, choose the cheapest item on the shelf so many times for that basket of eggs that they must have, right?
Yeah. Yeah, man. And so this is a problem in the U.S., but as we talked about, there's a problem globally. And the whole financial system is changing right before our very eyes, which is pretty interesting. We can see emerging markets are dropping like flies, and now there's protests all over the world with, we see, currencies going down. Now we see countries going basically to a standstill, stopping, and basically a new payment system that the BRICS nations are setting up in real time. So we have all these catalysts, which really signifies the world is kind of changing as we know it. But what does that mean for Bitcoin? And we're talking about some of these catalysts happening in the United States and the global financial system for that matter. So, I know you've done a lot of on-chain metrics looking at Bitcoin, looking at it from a bunch of different angles. And it seems like we've seen a lot. We've seen a lot of massive movements inside the Bitcoin space specifically. One of the things that it seems like to me, and I'd love to get your take on this, is that it looks like Bitcoin has been this kind of canary in the coal mine, if you will. So the Fed started saying they were going to start raising rates in November of last year. Bitcoin started selling off pretty quickly, pretty far ahead of the stock market. And now it seems to have kind of found this bottom. I think it's interesting when markets stop going down on bad news. So like we saw the Terra Luna liquidation, which was very bad news, and it crashed. And then we saw, the dominoes continue to fall, more contagion, and the Celsius and the FTX, and it's just continued to get on and on and on. But now we're still seeing more bad news. We started seeing massive Bitcoin mining liquidations happening, but yet the markets aren't moving down anymore. So what's your take on that? Do you think the markets have taken the bad news, we've absorbed it, and now these even more liquidation of miners aren't bringing the markets down?
So, definitely those first moves down, the energy behind them, there was a clear reason to push the market down, right? It was counterparty risk, unsecured debt, and liquidations. I think we've seen most of that now, and we're kind of in a weird place here because appetite for risk is essentially non-existent. Obviously, there are people who always want to buy Bitcoin when it's on a discount. I don't really mean those people, but just general market appetite for risk is way down. And I think that people are still kind of waiting to see what happens. Market participants broadly don't know what's going to happen. We got CPI next week. Q2 earnings are about to come in. We're about to find out if we're actually in a technical recession or not in a couple of weeks from now. So there's a lot of things the market's waiting for. And I think that it's certainly possible that Bitcoin might have reached a bottom. We came all the way down. We broke the 2018 all-time high, 2017 all-time high, which we hadn't done before in a bull market pullback. So that really kind of shook a lot of people's narratives and some of the dogmatic beliefs about what Bitcoin can or can't do. And I think some of that is healthy. long term for Bitcoin, for any asset, to kind of shake loose some, I don't know, irrational beliefs like that. So I think we've gone through most of that kind of pain. Obviously, something else could happen that pushes us down further. But I think that if you look at some of the other bear markets, just for Bitcoin alone, granted they came in that secular bull that you were talking about, Mark, but Bitcoin goes through these long periods of reset. It can be months. Sometimes there's been times where it's been years before it gathers momentum again. I don't necessarily think this will be years, but I do think that you're absolutely right. I like what you said about it being a fire alarm. My buddy Checkmate, who's the lead analyst at Glassnode, he was one of the first people I heard say that a long time ago, that it's like the last functioning fire alarm. I think because it's possibly the last great free market, because it's a highly liquid instrument that runs 24/7, 365, and it's borderless. It allows itself to react to changing economic conditions more quickly and more violently than most other assets and markets. And I think that's why it functions so well.
Now, I would agree with it's one of the most free markets that we have. Doesn't mean it's not manipulated. It's heavily manipulated by these big movements because it's such a small market cap. But so back to kind of this cascading event that we're talking about, right? So the Terra Luna blow up. They had to dump all their Bitcoin they had in reserves, and then the next domino, and then you got the Celsius liquidations and Three Arrows Capital, and all the liquidations. Don't need to go through all those. But, supply and demand, right? So we can make things super complicated, but we can also make them very simple. And like markets or prices are set by supply and demand imbalances in the market. And so there was more people selling than there were people buying, so it pushed the price down. But now to these giant liquidations that we saw, and we saw some big ones, right? Was it 18,000 Bitcoin were dumped into the market, something like that? Big numbers, but the markets gobbled those up pretty fast. So you would have, like, to the point you were making earlier, that a lot of that risk appetite is gone, which I would agree. It's been trading closely, like with the NASDAQ. Tech stocks, they're out of favor right now. But now Bitcoin is at a 400 billion market cap. It's very tiny. And you have these like true believers that believe in it for the long term. And so it's not a risk appetite for them. It's like, hey, I believe this. I can wait 5 years. I can wait 10 years. And we know that historically under 20,000 is like a historic buying, a cheap moment. And so we saw it sell down. But now 18,000 Bitcoin dumped in the market, and they got gobbled up. I mean, that seemed pretty strong to me.
Yeah, I mean, it can definitely absorb some sell pressure, right? And it depends on how those coins are dumped. If they're sold slowly over a period of time, if the bots kind of distribute them the right way, similarly to the way that Michael Saylor buys Bitcoin, then it can possibly just be absorbed by regular market liquidity. It's definitely possible, but I think, that kind of fervor where people just want to own Bitcoin and they're willing to market buy to get that Bitcoin wherever it is, that kind of appetite, I think we might be some time away for, or we're waiting for some kind of an economic catalyst, whether it's they turn QE back on and everyone thinks that solves the problem, whatever it is. I think a lot of people are waiting for that. That's where I think we will see a sustained uptrend. And I think maybe until we could agree that risk appetite broadly is more palpable, I think that we're in for more volatility. We might get a bear market rally and then it might come back down,
Sure. Yeah. And back to kind of what I was saying earlier, like at the top of these peak market cycles, we just get lots of volatility. But just for some numbers, I was just looking here. So in the last 2 weeks of June, Bitcoin miners dumped 18,251 Bitcoin worth $372 million. That's a lot. And the market absorbed that without dropping more. It did. I think it dropped it down to about high 19s, and then it popped back up just above 20. So like right when it was sitting on that, historical kind of point of that, 200 moving day average, so to speak, then those 18,000 Bitcoin got dumped in the market, and it dropped it a little bit lower, but now it seemed to absorb it and come back up. And maybe we don't have any more of these big liquidations there. I mean, I think one thing I was looking at was, potentially the Celsius position getting liquidated, but they've been able to continue to bring that level down, and now and I was afraid that, these Wall Street raiders were going out and really targeting these funds and these pegs to try to crash them so they can make some extra money, which I believe they were. And so seeing that like Celsius peg sitting at 18,000, well, they're going to hunt that, right? Well, 15,000, maybe they hunt that. Now it's down to, I believe, about 4,000 or 5,000. I don't see them trying to even bother with that, right? So I don't know if there's any more of these these Bitcoin miners, they've dumped the majority of what they were sitting on now. They still have, some of these big miners have 1,000 Bitcoin they could dump, but that's not 18,000. So
right.
Yeah, we don't know. Obviously, anything can happen. Things could continue to get way worse. We could see the European market blow up. Japan could blow up, drag Europe with it, drag the U.S. into it. We don't know.
Right.
But it seems like maybe we've seen the worst of it. That's kind of what I'm thinking.
I think it's possible, yeah.
Yeah, I want to get into what comes next. Like, where do we go from here? Are we on a 4-year cycle? Do you think those cycles are dead, like Michael Saylor said? When do you think? I was on Fox News with Charles Payne just before we started, and he said, "When will Bitcoin get back on track?" So I'll ask you that same question. Markets are a discounting mechanism, so basically that's what markets do. They try to guess if a price is going to be higher in the future or lower, right? And so then we're just here trying to play along. So we've kind of set the problem up pretty well. I think we've kind of both agreed that we've seen these massive liquidations. It's brought it down. Maybe there's not a bunch of more liquidations in front of it. Of course, if we use very simple terminology, markets stop going down when there's no more sellers. And so have we washed out the majority of the sellers? You talked about getting back below the 2017 peak. That was good. We talked about getting rid of all the leverage. I think that was good. We talked about the Bitcoin miners getting rid of all their books. I think that was a lot of liquidity. So how many sellers are left? We don't know. But they may or may not keep going down. We don't know. What happens, or what makes them go back up? Now, we know historically we've kind of moved on this 4-year halving cycle. Could it be possible that it takes 3 or 4 years to get back to an all-time high? Do you think it happens sooner? What's your kind of thinking process as to where we go from here?
Yeah, that's a really good question. That's something I spend a lot of time thinking about. And obviously, like you eloquently said, we don't exactly know what's going to happen. We don't know exactly the timeline. But there are some things we do know. One of those things is, like you mentioned a few minutes ago in the earlier segment, that Bitcoin has existed through a secular bull. And in that secular bull, inflation has always been about 2% or better or less. And we're now in a regime where I think it's reasonable to believe that inflation will not be at 2% anytime soon. It's probably going to stay elevated somewhere. Who knows where? 5%, 6%, 4%. Any of those values are very hard societally to stomach for a sustained period of time. And I'll bring everyone's attention to the fact that if we get it down from 8.6 to 5 or 4 or 3 or even 2, it doesn't really help you. So to the point I made earlier, talking about Lynn Alden's message, food prices went up 12% by when pay went up 6%. So food prices went up, gas prices went up. You can't afford them now. If inflation goes down to 6 or 5 or 4 or even back to 2, that doesn't mean the prices actually came back down. That just means they continue going up, but only slower. So exactly, it's a rate of change, and so even if inflation is, like you said, at 4%, it's still going up 4% a year from where it was already elevated, right? From where we already had 40-year highs in inflation. So and wages are just getting further and further behind that. So I think that we are in an environment where it's the past 4-year cycle pattern for Bitcoin, I think, is under threat of being violated simply because the economic landscape behind it has changed. And so, what if the Fed pivots to QE? Who knows what that looks like? But what if they turn the liquidity spigot back on? They start raining helicopter money, and we still have 5% inflation. We still have elevated costs. The priority of expenditures for the average household, the things that they have to pay for, all of those things are now more expensive than when they were the last time people wanted to buy Bitcoin, regular retail people. So I think that is a climate no one alive has ever seen before. It's certainly not in the QE era, where the Fed reverses back to easing while inflation is still extremely elevated. So I think that will play a factor in how quickly risk appetite returns to the kind of upward sustained bull run that Bitcoiners are used to when things are going well. So who knows how long exactly that takes. I believe that regardless of what happens with QE, I don't think that they can carry this on until next year, like deep into next year. I feel like sometime in the next calendar year, they're going to hit the cold wall of math, and they're going to have to rethink their plans simply because of the cost of debt. But generally speaking, if they pivot back...
mean, so you're saying you think they'll have to come off of this stance and come off this pivot in the next 12 months?
I think so. I mean, that's a loose guess.
Or this calendar year, meaning by December?
Calendar year between now and next summer, which is when the soonest rate hikes are priced in by the market, and they've been getting closer and closer to the present. They've been getting pulled into the present. So I actually think it's probably not that long. I'm being conservative. But the cost of debt is continuing to rise while GDP is weakening, and tax receipts are going to be threatened by lower spending. There's a point where they have to have some money to pay their bills, or they default, and they have to get that money from somewhere. And so that means printing.
Yeah. It scares me because the Fed doesn't know what they're doing, and Jerome Powell just recently told us that. We already knew that, but if he came out and actually said that, and I think, if I can't quote him exactly, but he said, we've just figured out how little we actually know about inflation, or something to that effect. I'm sure you heard that.
Yes.
Something to that effect. I talked to, it was a month or two ago, there was a meeting with Jay Powell, Christine Lagarde from the ECB, and Kristalina Georgina from the IMF. And Kristalina said they were all laughing, and she said, I guess we just didn't think about the unintended consequences of printing all of this money.
I heard that.
Like, we didn't think about that, right? And then she said, I guess we're sort of like a bunch of 8-year-olds playing soccer, where we don't cover the field, we just all follow the ball. So she said we're like a bunch of 8-year-olds. Jerome Powell said they don't know anything about it. So what scares me is that they don't operate with the precision of a surgeon with a scalpel, but rather a blunt instrument. They're operating with a chainsaw. Yep. And so it's like in 2018, 2019, it was like, we can't get the inflation. 2020, we can't get the inflation. They said, we're going to let it run hot. So they were saying, maybe we'll get to 4 or 5%, but we'll average that with being below, and so somehow we'll average it into a 2 or 3% number. So they were kind of okay to let it get to 4 or 5%. They got to 9. So now, 8.6, rounded up to 9. Now they're saying we're committed to get to 2, and they're going to crush all this demand. But do you think they're going to hit 2 perfectly, or are they going to overshoot that goal as well? And I'm afraid they're going to overshoot that goal as well. And they get really dug into these positions where we're not even thinking about raising rates. And they let it go on way too long. Everybody knows this. I mean, you and I, we're just guys on YouTube and the radio. Like, we're not PhDs with 1,000 PhDs working for us at the Fed. And like, we knew they were dug in on that position. They wouldn't come off of it. And now maybe they're too dug in. And I'm afraid of that. So we don't know how far they'll go before they'll come off that pivot. But I think everybody agrees at some point it's coming, right? Just when.
Yeah, they definitely are dug in. And, they love to use that forward guidance. Like we said earlier, they've done 90% of the work just from talking about tightening, and the market has responded. And I think because Powell is so committed to telling the market what he wants to do ahead of time, that he's afraid to ever surprise it for any reason, even when the data starkly changes against his plans. He still wants to tease out a multi-month, general turning of the barge. And I think that is, in a large part, why we're in this mess now, is his reticence to make quicker changes to his plan.
So real quick, 30 seconds. If they don't pivot, if they stay stuck on this for the next year, kind of to your best case, do you think Bitcoin just continues to kind of grind up and down, chop people up, and stick kind of in this 25,000 range?
Yeah, I think it chops around. Maybe it goes a little bit higher at certain points. I think there's you could make an argument that there's times where maybe we get a little bear market rally. We've been overdue for one, but I don't think that it breaks into any kind of price discovery at all until we're well beyond this current situation that we're in, and that might be into next year, depending on what a pivot looks like whenever that comes, depending on how aggressive that is.
Yeah, and that's anybody's guess. But what we do know is that we can see booms and busts continue to get bigger and bigger and bigger. And so in 2008, it was a $700 billion hole they had to fill, ended up being about 1.5 trillion. In 2020, it was 6 trillion, and the next one's probably going to be 15 trillion. Anyway, you're listening to the Mark Moss Show. Thanks so much for listening. See you next time. Since you've stayed to the end, I know you like this video, which means you're probably gonna really like this video right here and this video right here.